This is the 18th installment to the series Build Your Business into an Asset of Value. The best investment on earth is earth. Business media headlines are dominated by technology businesses, started by whiz kids in t-shirts and sneakers. Businesses with no fixed assets, with little more than promises about spectacular future profits. Very sexy. But in the real world, few things attract the favorable attention of financiers more than a business that own and operate from its own property, a bricks and mortar business. Property is a tangible asset and will almost always appreciate in value. Financiers understand property as an asset class and keenly accept property as collateral for loans, which is why finance rates for commercial property finance is lower than rates for other types of finance solutions. But securing commercial property finance is very different to residential property finance. I make this comparison because most individuals are familiar with the concept of a home loan. The rules that apply to commercial property finance is very different. Commercial property finance is offered at much higher rates of finance than residential property finance, and over much shorter loan terms. A commercial property finance loan typically run over 7 years, and financiers will almost always insist on a minimum 20% deposit. Consequently, the monthly debt installment on a commercial property loan is substantially higher. But there are other factors that financiers also consider. Property valuation. Retail banks, the types that provide home loans, invest large amounts of money to research valuations and trends of residential properties. Banks make use of public information, mostly from the deeds office, to keep tabs on property values in various geographies. The composition, that is the number and type of rooms of a residential property, together with the fit and finish of the property, are all factors that determine the value of the property. Commercial property is a different kettle of fish altogether. The potential income generated by a commercial property is the biggest factor determining its value. Financiers are more interested in information about rental income and occupancy when it comes to commercial property valuation. Property usage. It is assumed that residential properties are used for residential use. In fact, most home loan providers include a clause in the loan agreement prohibiting the use of a residential property for commercial purposes. Business owners need to take note of this. It is common practice amongst small businesses to operate from a residential property, which is less of a problem when an entrepreneur runs a small business as a sole proprietor. However, I recommend that any business owner investigate the bylaws that apply to property usage in the area so as to not transgress any legislation. But the moment the business becomes incorporated as a private company, things change. Banks do not want to offer a home loan to a business. The first thing the bank will ascertain when it receives an application for commercial property finance is the zoning of the property. Local authorities issue a zoning certificate indicating the allowable usage of the property. Another important aspect of property usage is insurance. Financiers will insist that the property owners maintain comprehensive insurance, but insurance companies will decline the technical term is repudiate, any claim for damages if the insured business provided incorrect information about the zoning of the property. Owner-occupied versus multi-tenanted. An entrepreneur may be motivated to acquire a commercial property to reduce the business's dependence on a landlord and to increase the balance sheet value of the business. But a business owner may also consider the income-generating prospects of investing in a multi-tenanted property. Owning a commercial property comes with added responsibilities, including maintenance, insurance, and legal compliance. Responsibilities increase where the owner also acts as a landlord to one or more tenants. Financiers will always insist on a rental roll, a document reflecting rental income received from tenants, when considering an application for commercial property finance. Where the application for commercial property finance depends in large part on rental income secured from tenants, financiers may also request financial statements of the tenants. Another aspect that financiers consider is the capacity of the landlord to collect rental income from tenants. Sometimes a financier will insist on the appointment of a managing agent to ensure rental collection. In conclusion, financiers and investors alike treat a business with fixed assets with more respect, and it often makes sense for a business to operate from its own premises rather than to continue renting. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.